Hello, everybody. This is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, March 22nd, 2025. We made it to the weekend. How you doing? I hope you're doing well. I hope you had a good trading week last week, and I appreciate you coming to my weekend review podcast. Boy, I've got a lot to go through on this podcast for the reviews of all the trades that I made, took, entered, exited last week. But I was comforted to see the market have some potential green shoots to the upside. We'll talk more about this, but Friday was your options expiration day, and we did close strongly into the close. So it does give me a little bit of hope for next week that we may have put in a short-term bottom. So the format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back and we're going to take a look at all the trades that I made last week. We're going to talk about when I entered the trades, why I entered the trades, what the signals were, what the confluences of signals were that got me into the trade. We're going to talk about how I position size correctly, how I placed my emergency stop, how I placed my end of day stop, how I take partial profits if the market goes in the direction that I want it to, how I tighten up my stop once we get into trailing stop mode, and then ultimately how I am going to exit the position. So I'll try to take you through my entire process, and then I'll show you all the open trades that I have, when I entered, why I entered, and how I am going to manage it going forward, and how they are doing now. I trade both on the weekly and on the daily and the weekly charts, and so I have open and closed trades both on the daily and the weekly. I have a lot of trades. I have a lot of open trades. It's probably more trades than I've had in a year or longer. But the reason why is because the signals are there. There's some strong signals, some strong deep dip buy signals, order block signal combinations that I have taken, and gratefully, a lot of them are doing well. So we'll go through those. I hope that's going to help. I hope it's going to give you an idea of how I look for trades and then how I manage them going forward. After that, we're going to talk a little bit about trader psychology. Trader psychology is the most important skill in trading. It's simply the ability to create a good trading plan, have a good trading process that incorporates um, correct trading fundamentals, which are position sizing correctly, having good risk to reward ratios, and ultimately getting out quickly if you're wrong, and having the ability to have a big upside trade if you're right. You're going to take a lot of little losses in trading, at least the way that I trade and the way that I teach to trade. You're always going to have a little losses, but you have to have some large winning trades to pay for all those little losses, and so you have something left over, which is your profit. But back to trader psychology, it's not hard to learn a good trading process, right? It's not hard at all. I I teach that. That's what I do. The difficult part is following that process. Sounds easy when you start out. Okay, if it does this, I'm going to do that, and if it does that, I'm going to do this. That sounds very easy. But a lot of traders have difficult time with that. They get out, maybe it starts going up, feels good, they want to get out of the trade when they shouldn't get out of the trade, and then a week later it's much higher, or they've hit their stop. Their trade rules tell them that they have to get out, but they don't get out, and then it goes down for a week. What do you do then, right? So we're humans. There's emotions. That's why most traders fail, is that they cannot follow their process. So that's why I like to talk about trader psychology. It's the ability to create a plan and follow it. And so it always helps me to teach this because I'm human as well. But um, it helps me to teach it, and I hope it's going to help you and sink in. All right. After that, every Friday night, I go down through my master watch list of stocks and different markets, and I identify potential trades for the upcoming week that potential or that that if the price gets where I need them to be, that location is going to be a strong level of support if I'm going long, or a strong level of resistance if I am going short. One of the biggest advantages we have as far as being uh, small retail traders is we have the ability to just wait and wait and wait for the perfect setup. And when that perfect setup comes, then we have the opportunity and we have to make the decision whether we're going to enter the trade or not. But your biggest advantage is being able to just wait and wait and wait for that perfect location. And what I am trying to do in this podcast is show you next week where some perfect locations would be if these markets get to those levels. And even if they get to those levels and it's the most perfect location, it still doesn't mean the trade's going to work, but it drastically improves my chances of having a profitable trade if I wait for those markets to get to those levels, right? So that's what I'm going to go through. I'm going to show you the levels that I'm looking for, and if those markets get to those levels next week, I'll potentially take the trade. If they don't, fine. I won't bother with them whatsoever because I don't want to get into a subpar trade. I only want to put my money to work if I get to a really optimal place. And trust me, they get there all the time. I mean, hardly a week goes by where something doesn't get where they're going to get, or where I want them to get to. And so anyway, I hope that's going to be helpful, give you an idea how I look at trades, how I look at the market, um, how I enter position size, and the entire process of the trade. So if it is helpful for you and you find it of value, I really would appreciate it if you could hit the thumbs up button. It really does help the channel. It lets YouTube know there's some valuable content here. And so if you like it, I appreciate a thumbs up. If you could subscribe, that would be great as well. And just have more people learn about the channel. So let's go ahead, run the U.S. legal disclaimer, get that out of the way, and then we will get started. So hang tight. Thank you very much.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started with Apple. So this particular trade, I'm going to be a little bit more detailed in how I position size and some of the rules and some of the processes, but I have many trades to go over, so I won't be as thorough on all the trades. But on Apple, to start out, I'm going to be pretty thorough, but don't worry, not all of them are going to be this long. So I trade 7 different strategies, and sometimes of the year I trade a lot of the same strategy. Right now, the strategies that I'm trading, because of the recent sell-off we've had them in the market, are almost exclusively deep dip buys, which incorporate the 250, the 200-day moving average, the 300-day moving average, and or rejection of the 30 RSI and order blocks. So we are in order block city lately, and you can see an order block is this green box here. This green block is called an order block. So, when you get into this green area, this is a buyable area. But because the market has been how it's been, there's a lot of nice combinations of rejections of the order blocks and also of the major moving averages, which are really strong signals. Doesn't mean they're always going to work, but they are strong signals. So I did enter Apple on the 14th of March at 213.50. So why? Well, a combination, actually. So first off, the day before I entered, we rejected the top of the order block. And an order block, by the way, just so you know, You're going to go back in the past and look for an order block. And sometimes these things can be months away, even years away, but they tend to have a memory. When the markets get back to that location, they tend to bounce. And I'm trying to get this on the screen here. This order block goes all the way back to the 6th of August. And what's an order block? An order block is your lowest bar close before you change market structure to the upside by taking out a swing high. You see this swing high here, we take it out. As soon as this takes it out, we now create this order block. It's the high and the low of the order block. And you run that out into the future, and that is what you're looking for. And that's what I'm looking for, I should say. So I did take the trade here on the 14th of March because one, we rejected the order block, and two, we closed over the 300-day moving average, which is a deep dip buy signal. Close under, close over, but the confluence was the close under, close over the 300, and the rejection of the order block. That is a strong signal. So okay, so that's the signal. I'm going to enter. Now, the big question is, how many shares am I going to buy? This is extremely important, everyone. This is probably the most important part of trading, is how many shares you're going to buy. Doesn't matter how good the setup is. You need to enter the correct amount. And the way that I do it consists of two things. What is the value of my account? And what is the value of the 2 ATR, the average true range of 2, at the day that I enter? So the way that I do it is this. First of all, how much is in my account? Okay, let's say it's $100,000. I take 1% of that. That's $1,000. If it's a $50,000 trading account, it's $500. If it's $1 million trading account, it's $10,000. It's all the same, 1%. So let's just say it's a $100,000 trading account. 1% is 1,000. Then I take that 1,000, I divide it by the value of the 2 ATR on that day. Right now it's 1390. So 1,000 divided by 1390 tells me to buy 71.94 shares. Well, I'm just going to round that up to 72 shares. So based upon the volatility and the average, the 2 ATR, the average true range of 2, is factoring in the volatility. So it's just as simple as that. Taking your maximum allowed loss divided by the value of the 2 ATR, this tells me to buy 72 shares. Okay, so I have the close under, close over the 300. I have the rejection of the bullish order block. I enter at 213.50 with 72 shares. Now, the very first thing you need to do is whatever the value of the 2 ATR was, 1390, take your entry price minus 1390. This is the red line here. This is my emergency stop. So if the next day it comes crashing down and goes to my emergency stop, I'm out immediately. And how much have I lost? Well, we did the math. I lose $1,000. I lose 1% of my account. But the good news is that that only happens about 5% of the time. The other 95% of the time, if I have a loss, it will not be my emergency stop. It will be my end of day stop. And what is my end of day stop? Well, I got in the trade first and foremost because of the close under, close over the 300-day moving average. Therefore, in the future, if it closes under the 300-day moving average, I'm going to get out. And if it just barely closes under literally 1 penny, well, I'm out for a small loss. So 95% of the time, your end of day stop is going to be significantly lower than your emergency stop. But sometimes, 5% of the time, you do hit your emergency stop. Now, I just want to mention that I make all my entry and exits based upon the closing price right before the market closes, because that's the most important price of the day, is the closing price. That's because all the large financial institutions come in, they're dealing with the most money, very smart people, the best technology, best information. They are the ones that rule the roost at the end of the day. The closing price going into the close those are the large financial institutions putting money in or taking money out. So that is why the end of day price is the most important price to make your decisions from. However, with your emergency stop, I don't wait for the end of the day. If it touches it 1 minute after the market opens or 1 minute before the market closes, I simply get out because I cannot lose 1%, more than 1% of my account. Okay, so again, we have the bullish order block from way back, like I showed you. We have the close under, close over the 300-day, which is the deep dip buy strategy that I use and that I teach. My end of bar stop is simply a close below the 300-day moving average. Okay, now once I've entered with the correct amount of shares, I've placed my emergency stop, then the next thing I need to do is I need to place what I call my trailing stop level. And what I do here is I take my entry price again, and then I add the value of the 1.5 ATR. And where is my 1.5 ATR? Up here. Here it is. $10 right now, it's $10.42. So I take my entry price, add 1042, and I place this line. This is my trailing stop level. So this means once I enter, if I ever get to that trailing stop level, now I go into trailing stop mode, which is just another way of saying I'm going to tighten up my stop. So once I get there in the future, you can see we're not there yet, but if we do get there, then in the future, if I have a close below a previous bar's low, which is a bearish signal, I'm going to sell half of my position. And selling half of your position is one of the best, is about the only win-win scenario in trading, because if I sell half my position and it then goes up, I'm still glad I have half. If I sell my position and it goes down, I'm glad I sold half. Makes sense. So it's just a way of tightening up your stop, and that's just proper trading. The higher your trade goes, the more you want to tighten up the stop and protect profits. All right. So everything I have talked about so far, the waiting for your signal, the confluence of signal, position sizing correctly, placing your emergency stop, knowing where your end of bar stop is, knowing where your go into trailing stop mode. These are all defensive moves. Or in other words, if the market goes against me or does something I don't like, now I have a set of rules to follow. However, I also like to play offense in my trading. It's very important. And the way I play offense in my trading, and I'll show you exactly, is that I take partial profits if the market moves up a certain amount from the previous day's close. So I'll show you exactly. This is a current trade of mine, Apple. The way that I do it, I take the closing price every day. At the end of the day, I take the closing price. So it's 218.27. Then I look for what is the value of my 0.45 ATR. Right now it's 313. So I take the closing price, 218.27 plus 313. 221.40 is my first profit target for Monday. And how much will I sell there? I'll take 10% of however many shares I go into Monday with. I have 100 shares, I will sell 10 shares at that level. Okay, if I have 500 shares, I'll sell 50 shares at that level. But I do it 3 times. So I have the first profit target, 218.27 plus 313 is 221.40. I do it again. I take the first profit target, which is 221.40 plus 313. My second profit target for the day is 224.53. Then I do it one more time. I take the second profit target, 224.53 plus 313. My third profit target for the day is 227.66. And again, how much will I sell at each level? 10%, 10%, 10%. If I go into it with 100 shares, I'll put a limit order in the system. 10 shares at the first profit target, 10 shares at the second profit target, 10 shares at the third profit target. It's important for me, at least, to take partial profits when the market gives them to me. You'll see many professional traders doing the same thing. You know the feeling. You get into a trade, it goes up, woo-hoo-hoo, then you give it all back. It's not fun, right? Well, using this partial profit, you won't go through that as much because if it goes up, you will be taking partial profits into that. All right. So that is how I do my partial profits each day. Okay, so that's the offense and the defense. The taking the partial profits is the offensive part of the approach. Okay, so here we go. Now we've kind of got everything going, and just quickly we'll revisit the trade. So again, the trade was close a deep dip buy, close under, close over the 300-day moving average. The confluence there is we also rejected the order block. We position size. We got in with the correct amount of shares. I have my two ATR emergency stop below. My end of bar stops a close below the 300-day moving average. I place my 1.5 ATR trailing stop level above, and off we go. Right? I know exactly what I'm going to do now, regardless of what the market does. So the next day, it doesn't do much. It does go below the 300-day moving average, but that was during the day. I wait until the end of the day. It closed above, so I stay in the trade. The next day, down a little bit, but it closes above the 300-day moving average. I stay in the trade. The next day, we have a nice up move where I did hit one profit target and took 10% of the shares that I entered with off. Next day, no profit target, but we hold above. You can see Friday, of course, we opened low. You can see we opened under the 300-day moving average, which is my end of day stop. But then we rallied strongly into the day, and so I hit another profit target. So far, not too bad. Currently, the trade on Apple up 2.13%. We have not got to trailing stop level, but once we do get to trailing stop level, then if I have a close below previous bar's low, I'm going to sell half of the remaining shares I have going in. So, okay, so this is Apple up 2.13%. All right, now we're going to get on to the other trades. I won't be as detailed in these trades. Okay, this again is AMD. This is the confluence of signals that I have. There's actually many. I did get in on the 4th of March at $100.50. Why? Variety of reasons. One, we're in the bullish green order block. Two, this is a deep dip buy where the previous day before I entered it closed under the 30 RSI and then closed over the 30 RSI. That is a legitimate deep dip buy signal. Close under, close over 300. But again, it happened in the bullish green order block, which makes it even stronger. On top of that, we have this channel. If we connect the swing low here to the swing low here, and then we run it out in time, that is like a trend line that it should hold, and it did. So close under, close over the 300-day moving, close under, close over the 30 RSI. We're in a bullish green order block. We rejected this trend line, this channel line. So lots of good signals. I entered $100.50. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close back under the 30 RSI because that was the main reason I took the trade. Close under 30, close over 30. So therefore, in the future, if it closes back under 30, that's my end of bar stop. Place my 1.5 ATR trailing stop level here. As soon as I bought it, it went down for 5 days straight, but it never closed below the 30 RSI. It never closed below the support of this trend line, and now it started to move up. Hit some profit targets here, hit some profit targets here. The next day, hit some profit targets. Next day, nothing. Wednesday, up big, hit multiple profit targets. Thursday went up a little bit, no profit targets. Friday was down just a little bit. But look, I am in trailing stop mode now. So that means going forward, if I have a close below a previous bar's low, I will exit the half of the shares that I have remaining. Do I still have the same shares that I entered with? No, because I took partial profits, but I have the majority of them. So whatever I have left, I will take off half if we have a close below a previous bar's low. This trade's doing nicely, up 5.67% from that deep dip buy. And by the way, I've talked a lot about deep dip buys and order blocks so far. I do use 7 different trading approaches, and I teach a one-on-one course. I've taught people from all over the world. I've taught from absolute beginners all the way up to the hedge fund level and everywhere in between. But if you would like someone that's experienced, I've traded for almost 30 years now, and I love to teach. But if you would like to have me teach you, I have a one-on-one course that's 15 hours. I teach you each strategy that I use. I teach each rule step by step, and when you are done, you are going to be a much better trader because I'm going to teach you everything that I know. And learning one-on-one, in my opinion, is the best way to learn anything. If I go out and want to learn something, I always hire a one-on-one coach because I'm not competing with other people. I get to know them, right? And I can ask them all my dumb questions, right? But so it's a 15-hour course. Each session is 3 hours. We do 5 sessions, and I would love to teach you. Really, I just love to see my students have that aha moments where they start to learn things and they see them and then they're trading and they message me, oh, hey, Greg, that did work, and so forth and so on. So if you're interested, my email is in the link of this YouTube video. Just send me a message and then we'll have a Skype call. It's not a sales call. It's just to get to know each other a little bit, see if we're a good fit for each other. But anyway, love to hear from you, so send me an email. So, okay, back to AMD. It was a deep dip buy with a combination of an order block, and so far the trade up 5.67, which is really nice. Okay, let's go to DIA. DIA is, man, did I nail that one? Really, I nailed that one. Here, I bought this at 313 on 313.25 at $408.90. Why? It's that powerful combination of a major moving average inside of a bullish order block, the green block. Bought this at 408.90, was an intraday rejection of the 300-day moving average. You see how we went below it during the day, but just closed above it at the end of the day. So I position size, I placed my emergency stop 2 ATRs below. Where's my end of bar stop? Simply, if the next day it closed 1 penny below, I'm just out of the trade. But it didn't. It held. I placed my 1.5 ATR above. Next day, rocketed up, hit multiple profit targets. Next day, rocketed up, hit multiple profit targets, got to trailing stop level. So now I'm in trailing stop mode. The next day it goes up again, hit another profit target. Thursday didn't do anything. Friday, at one point, it was below the previous bar's low. So had it closed there, I would have exited half of the remaining shares that I have. However, we rallied into the end of the day, and this did not close below the previous bar's low. So I stayed in the trade. So but that shows you the power, of this huge move down. As soon as we rejected a major moving average that was inside of the order block, that's where it held. So this trade doing very, very well. Currently up 2.54%. All right, let's go to Google. Google, same deep dip buy combination bullish order block. I entered here on the 18th at $100.60. It rejected the bottom of the order block. Also intraday, it rejected the 30 RSI, which means during the day it went under the 30 RSI, but recovered and closed back above the 30. That by itself is legitimate, but with the combination of also rejecting the bottom of the order block, made a good trade. So I got in 106.50. I placed my emergency stop 2 ATRs below. My end of bar stop, simply a close below the order block. Placed my 1.5 ATR trailing stop level above. Next day, did go up, hit a profit target. The last couple days hasn't done much, but it is up slightly, and grateful for that. And so far, this particular trade's up 2.13%. All right, let's go to Caterpillar. Again, order block, deep dip buy combination. I bought Caterpillar back here on the 4th of March. rejection of the order block, rejection of the negative third ATR channel. I got in at 326.70. Placed my emergency stop 2 ATRs below. My end of bar stops a close below the order block. I place my 1.5 ATR trailing stop level here. Next day moves up, take profits. Next day gets to trailing stop level. Next day, big move up, took more potential profits. Now I'm in trailing stop mode. Next day down. Next day we do close below a previous bar's low after reaching trailing stop level. So I took off half of the remaining shares for a gain of 3.81%. Then we go down for a few days. Then we go up where I took a profit target. And then we've kind of muddled around here. It was starting to kind of get weak on Friday, but it did reverse. But the remaining shares that I have on Caterpillar currently up 2.69%. All right, let's go to Amazon. Amazon, I did enter, same thing, deep dip buy, order block combination. I got long Amazon on 310.25 at 194.60. We rejected the bottom of the order block. We also rejected the 300-day moving average. I got long 194.60. Placed my emergency stop 2 ATRs below. My end of bar stop is a close below the 300-day moving average. Placed my 1.5 ATR trailing stop level above. Next day, went up, hit a profit target. Next day, gapped open, hit a profit target. Then we moved down, no profit targets. I was glad to see that here on the 18th, we tested the 300-day moving average again, closed above. And this one not up much, but it is up. It's still holding the 300-day moving average. This one up 0.74%. Alibaba. All right, finally, a different trading strategy. I am short Alibaba, and I am short based upon a strategy that I use and that I teach called an abandoned baby. I love abandoned babies. I love island reversals. They're very similar. Abandoned babies consist of 1 bar. Island reversals consist of 2 or more bars. If you'd like to learn more about those, go to my YouTube channel. I have a nice video in there that explains bullish and bearish abandoned babies and island reversals. So let's go all the way back here to the 21st of February. What's important about this? You see I have this highlighted in red. What's important about this is that the previous day we were down and then we gapped up. So overnight, whatever the news was, it was bullish. The sentiment was bullish and we gapped up. People were excited about Alibaba. But then the very next day we gapped down. So we went from extremely bullish with the gap up to extremely bearish with the gap down. Why is this significant? Well, it's significant because when you have these sudden changes in sentiment from very bullish to very bearish very suddenly, more times than not, over 70% of the time, in my experience, when this happens, you look out into the future, the price is going to be lower. If you have a bullish abandoned baby, meaning you gap down and then immediately gap up, in my experience, I look into the future, 70% of the time, it's going to be higher. All right, so when these happen, I really pay attention. Now, when these happen, it's fine. You can short immediately, but I don't usually do that. I wait as soon as you have a gap up and a gap down. I wait for a rally back up to see if it rejects the bottom of the abandoned baby. That's the key level, and you can see it's exactly what happened. Gap up, gap down. And then we rally back up and we reject the bottom of the baby. That is when I get short. I got short 139.20. Now, with this particular strategy, I don't phase out. I don't have trailing stop levels. I try to make this one as easy as possible. I make it very simple. I'm short here, 139.20. I position size, like I showed you, taking 1% of my account divided by the 2 ATR and having a 1% maximum loss. And I put that emergency stop up here, 2 ATRs, right? Because that's where we put our emergency stop, whether we're long and short, 2 ATRs. I put it up 2 ATRs. That is my loss level. However, I need a profit target as well. Well, this is down here. This is 4 ATRs below my entry. So that's proper trading. That's proper risk to reward. I'm risking 2 ATRs to make 4 ATRs. And so my stop, 2 ATRs above at 152.90. My profit target, 4 ATRs below at 112.40. And like I say, in my experience, about 70% of the time, I make twice as much as the 30% where I lose half as much. Make sense? So this one's been kind of a wild one. Once I shorted it for the first week, it went immediately in my direction. It's like, great. Then we rallied back up. I was up, I was down. Here on the 17th, it's getting kind of close to my 2 ATR stop. I said, well, this one must be one of the 30%. But since then, we have moved down, not anywhere close to the 4 ATR profit target, but nonetheless, still positive for a gain of 3.09% on the bearish abandoned baby. Okay, let's go to IBB. Have a lot of trades here, everyone, but I think it's good, right? Showing you different trades, different strategies. Okay, so you've heard me talk a lot about the bullish order block. Well, this is a bearish order block. It's the same thing. It's just in reverse. You can see this red block here. That is an order block. Why is it an order block? Well, if you go back here to the 5th of February, we have, and this is your highest up bar close before we change market structure to the downside. So now this changes market structure to the downside. Therefore, I want to short any rallies that reject the bottom of the order block. Well, that happened here on the 21st of February. You can see we went into the bearish order block and then closed below. The confluence on that signal is not only did we reject the bottom of the order block, we also rejected the 200-day moving average, which is important and adds a lot of credibility to the trade. In addition to that, we have a bearish V1 to the downside. In this particular case, the bar before, we have the high. On the day I took the trade, it went above it during the day, but closed below it at the end of the day. You'll hear me talk a lot about V1s and V2s if you listen to this channel. Though they're really good entry signals, they add bonus points to any trade. And if you'd like to learn more, just go to my YouTube channel. And I have a video there. And of course, I teach V1s, V2s in my one-on-one course as well. So I got short here at 138.90. I placed my emergency stop 2 ATRs above. As always, my end of bar stop is simply a close above the high of this order block. I placed my 1.5 ATR trailing stop level below. I am short in this trade, so if it moves the value of 0.45 or greater going down, I cover 10% of my shares, right? So I got short. Next day, it didn't do anything. Next day, moves down nicely. I took some profit targets. Next day was down. Can't remember if I hit profit targets there. The next day was certainly down. I believe I hit multiple profit targets on that. And then the next day is an important day because I got to trailing stop level, which means now, because I'm short in the future, if I have a close above a previous bar's high, I'm going to get out of half. Well, the next day gapped open and then entered much, much lower, where I took multiple profit targets on the short. Next day, gaps down lower, went lower, again, took some more profit targets. Next day, we're up. This is our first day that we have a close above a previous bar's high after reaching trailing stop level. What did I do? I covered half of my shares for a gain of 2.52%. Then we went up for a couple days. Then we had this big down bar here where I hit 3 profit targets to the downside, right? Then we move sideways, move sideways, move sideways. And then this week, down, hit some more profit targets. Thursday, hit some more profit targets. And currently, this particular trade, the remaining shares that I have on this short, up 4.01%. Now, as soon as if we get into the 35 RSI level, then I will bring in the 5 EMA as a trailing stop level. So or if we reject the 30 RSI, then I'll take off half. And to get out of the remaining shares that I have after rejecting the 30 RSI, if I have a close above a previous bar's high, then I'm out. I know it sounds complicated. Really, it's not. It's not. And this is what I teach in the lessons. But I know on the surface it may sound complicated, but it's not. But this has been a really great short and a good example of shorting a bearish order block. But yes, the remaining shares here up 4.01% on the IBB short. Okay, is that it? Ah, that's it. Okay, no, Intel. Intel, really good example of interesting, an order block of an order block. Now, I exited this trade fully on Friday. Why? Well, excuse me, let's first talk about why I entered the trade. This is a bullish order block. This is an order block within an order block. The blue is an order block from way back. And if you've been following this channel, you know that anytime we have gotten into the blue area or rejected the bottom of the blue area, I have gotten long Intel. I took this trade here, really good one. I took this trade here, look at that trade, right? Now, when I entered the trade here on the 11th of March, for one, we're inside the big order block, the big blue order block. But I mentioned the week before, I'm really looking for this other order block. See, this is an order block within an order block. Here's your lowest bar close before you change market structure. On the day that I took the trade, it rejected the top of the order block. So I got long here, 1977. Place my trailing stop level above, my 2 ATR emergency stop below. And where's my end of our stop? Simply a close below the order block. And then we just took off like a rocket ship. Next day up, multiple profit targets. Next day, way up. I had to add more profit targets to this. I think on this day I hit 5 profit targets, maybe 6. I'm clearly in trailing stop level. And it just keeps going up. We have 1 bar nothing, then we go way up. Now, on this particular day, these are other rules on how I get out. Once I ever get to a 65 RSI, then the 5 EMA comes into play because this is the shortest period indicator that I use, and so it's going to hug the price very closely. And so it's a good, quick moving average that will, if the market closes below it, you will lock in the majority of gains. And so, yes, I phased out of a lot of shares here. The trailing stop level would have come into play on the day that I entered, but I exited the entire trade because I was at 65 RSI or higher, and then it closed below the 5 EMA. So on Wednesday, I exited this trade. It was a monster. It was a monster, 17.95%, with a very good risk to reward ratio, with a very high probability trade of rejecting 2 bullish order blocks. Pretty nice, right? Pretty nice. You got to learn yourself some order blocks. You really do. And like I said, I'd be very happy to teach you. So this, I did exit this trade. So this one's done for a gain of 17.95%. Okay, so those are all the daily positions. I also trade weekly charts. So I have 3 of those, and then we'll be done. These are bonds. Again, these are weekly bars. Every bar is a week. I got long TLT here on January 17th at 87.20. Why? Well, again, it's an order block. We're in the green order block. The week before we closed under. The week that I took the trade, we closed over. We also have a V1, bar 1, bar 2. Bar 2 goes below bar 1, closes bar above bar 1's low. So there we go. That's the trade. I enter 87.20. My particular choice for end of bar stop here is halfway of this big up bar. Usually when you're at halfway of a big up bar, you'll have some support. So some of the other trading approaches that I use and that I teach, if we close below halfway of the up bar, I get out. So on this particular trade, that's why I have this line here at 86.20. So in the future, if it closed below halfway here, I would just be out of the trade. But thankfully, the order block was good. I placed my 1.5 ATR trailing stop level above. Next week, it's about break even. Next week, up a little bit. I hit a profit target. Next week, up again, hit a profit target. We had a couple weeks sideways. On the week of 228, big up bar where I hit multiple profit targets and also got to trailing stop level. So what does that mean? It means in the future now, if I have a close below a previous bar's low, I will get out of half. But this week was up a little bit, and it certainly wasn't a close below previous bar's low. So I am still in the weekly long trade on TLT, which bonds currently up 3.9%. Almost done, everybody. Thank goodness. Okay, DDM. DDM, great trade. Great short trade based upon a bearish order block. You can see here's your order block, your bearish order block. Doesn't look bearish because it's up, but it's backwards, right? Here's your highest up bar close. We change market structure here by taking out this swing low. Now any rally back up to this bearish order block for me is a shortable area if I get the right price action. Here I get short on 131.25 at 103.70 because during the week we went into the order block and then closed below it. So we rejected the bottom of the order block. So I enter my short 103.70, my emergency stop always 2 ATRs above, my end of bar stop or end of week stop in this case close above the high of the order block here at 107.53. I place my 1.5 trailing stop level below, and then on every Friday I have to make a decision, right? If I'm in or out of the trade. The next week it goes down. I had profit targets sitting in the system below. I did hit a partial profit. Next week it goes up. This week here, big down. I hit multiple profit targets to the downside. Next week, no profit targets, was up a little bit. The week of the 7th of March, down huge. I hit multiple profit targets, covering more and more of my short. Also got to trailing stop level. Then this week, many more profit targets again. And then the current week, we're up a little bit. So I am in trailing stop mode. I have not closed above a previous bar's close. So I'm staying short, taking profits every time the market goes down at least 0.45 ATR. So this has been a monster trade, everyone. Really, this really has been a monster trade, up 12.87% on this short from the bearish order block. And then last but not least, Tesla on the weekly. All right, well, Tesla's been in the news. It's obviously had this huge move down, but I had a buy signal last week. What was the buy signal? Well, first of all, we are in the green order block, right? Here's your lowest bar close before market structure change. So you run that out into the future. Look at that. There is the 200 week moving average, which is an important moving average, everyone. And it's the combination that I like. The major moving average inside the order block. So last week, we went below the 200 week moving average and closed back above. So that's why I took the trade. I took the trade at 249.99. My emergency stop is 2 ATRs below. My end of bar stop is simply a close below this 200 week moving average. Well, during the week, it was down a lot, but it did rally and it did close above the 200 week moving average, which kept me in the trade. Look, the 200 week moving average is 248.41. We're at 248.67. We are above. We closed above. Had this closed 1 penny, had this closed at 248.40, I simply get out of the trade. But it closed above, so it kept me in the trade miraculously. So this particular trade down very, very slightly, very, very slightly, like down 0.42%, but it was down significantly during the week. So those are all the trades, everyone. I'm sorry there's so many of them, but I guess it's good to see a variety of them. Order blocks, deep dip buys, bearish order blocks, bearish babies, all sorts of crazy names, right? So I hope you found that helpful. If you have any questions about those trades, feel free, just send me or write it in the comment section. I'll do my best to get back for you. And if it was helpful, like I said, if you could hit the thumbs up button, I would really appreciate it. So let's head over now and talk a little bit about trader psychology. And then after that, we will talk about the potential trades for next week. So let's go to trader psychology now. Okay, now look, this saying I don't think was intended for trading. However, it's completely relevant to trading. So let's look at it both ways. Let's look at outside of trading first. Laziness kills consistency. Totally true. How can you be consistent at anything if you're lazy? Comfort kills consistency. So you want to stay in your comfort zone, not do the things you should do. That consists of killing the consistency that you want. Doubt kills consistency. If you have doubt, it kills your ability to have consistency in what you're doing. And fear kills consistency. All true in life in general. Now read that again, right to left. Consistency kills laziness. Consistently kills comfort. Consistency kills doubt. Consistency kills fear. All true, really clever, really nice. Makes a lot of sense. But let's look at it in trading terms. Laziness kills, when I say consistency, I mean following your process, taking the trades you're supposed to, getting out of the trades you're supposed to. Okay, so let's put it in that context of consistency. Let's just put in following your process. Laziness kills following your process. Maybe you're not doing your homework. Maybe you're not around your computer. You're not working, right? Laziness kills your consistency or kills following your process. Comfort kills your consistency or your following your process. Comfort means, well, I don't know if I want to get out of this and take the loss, and it makes me uncomfortable. And I don't know if I want to get into this trade. It makes me uncomfortable because everything on the news sounds bad. I think the market's going down, blah, blah, blah. But then again, I have this signal, but I don't want to get out of my comfort zone by taking this trade. That kills consistency. Doubt kills consistency, or doubt kills following your process. Well, I don't know. I don't think this is going to go up. I mean, again, the news is bad, so forth and so on. I have doubt. Doubt interferes with following my process. Fear, of course. Fear of taking a loss, fear of being wrong again. That kills consistency or kills your trading process. Totally true. Let's read them back. Following your process kills laziness. Following your process kills comfort. Following your process kills doubt, and following your process kills fear. If you want to be a successful trader, if you want to be a profitable trader over the long run, everybody, I've traded for 30 years. I know so many traders that have blown up their accounts. The ones that make money are the ones that have a process. And the ones that have a process are the ones that make money. Take it from me, everybody. It's the truth. Whether you learn a process from me, which I'm very happy to teach you, or you learn it from someone else, you have to get yourself a process so you know exactly what you're going to do, regardless of what the market does. So I hope that put it in perspective. I thought that was kind of clever, and it really does apply to trading. Okay, let's get over to the potential trades for next week. I've got some good ones. Now, I always like to say this at the beginning. Here on the daily, I have 10 potential possible trades for next week. I have a rule that I follow religiously. I only take one trade per day. Theoretically, all 10 of these could trigger on Monday. But would I take all 10? No, I only take one. And how do I decide which one? I give every trade a quality score. How many signals were there? What's the risk to reward ratio? How does it look on multiple time frames? What's the relative strength of this particular market compared to the rest? If it has 2 entry signals, I give it 2 points. If it has a bad risk to reward, maybe I take a point away. So I know at the end of the day which one has the highest score, has the best report card, and that is the trade that more likely than not will be the best chance to have a profitable trade, right? And this is what I teach all of my one-on-one students. I teach them this approach of scoring the trade and how to differentiate one from another. So with that said, here's potential 10. I'm only going to take one trade per day. Okay, let's look at AGQ. AGQ is double leverage silver. Look, here is a very good location to buy this. Is it going to get there? I have no idea. But this goes back to me telling you about what I do on the weekend and go, well, this is perfect. Look, here's an order block in the green. Look, I have a 250-day daily moving average here inside the order block. I know that when I have a bullish order block and I have a major moving average, it's a very high probability potential trade for me with a very good risk to reward ratio. So we're quite far above this confluence of signals right here. So, if I had to guess, I wouldn't think it would come down here. But what do I know, right? Maybe it will. Maybe it will. But if it does, and comes down and rejects that 250-day moving average and then rejects the order block, that would be an excellent risk to reward trade. So that's what I'm saying. I look at this and go, that would be perfect if it got there. If it gets there, I'll consider taking it. If it doesn't get there, it's not perfect and I don't want the trade. So that's what I'm looking for next week. AGQ to reject the 250-day moving average, the purple line. And by doing so, by default, it would reject the top of the order block. So that's confluence. So that's what I'm looking for in AGQ. Carnival, CCL. Okay, well, Carnival, it had a legitimate entry signal here on the 11th of March. Why did I not take it? Well, I saw something better on that day, right? But so we got into the order block. We rejected the 300-day moving average. We had a V1. Now we've moved up. It's moved too far. I'm not going to chase it here. But what I'm looking for, potentially, if we do come back, another retest and rejection of the high of the order block of about 1914. Then we would have a higher low rejection of the order block. It's the only way I'm going to get interested in. I'm not interested if it rejects the 250 like it did on Friday, only if we have a little bit of a back test and reject the high of the order block at about 119, what is that, 119.20, about 119.20. If it does that, then my risk to reward ratio is better. Here, the risk to reward ratio is bad because my risk to reward, my end of bar stop would be a close below here, the low of 1816. So it's a bad risk to reward ratio. But if we do come back down, I don't know if we will, but if we do come back down, reject the high of that order block, then it gives me a better risk to reward ratio and I get better pricing. So that's what I would be looking for on CCL. Goldman Sachs. Okay, another one. There's a major confluence down here about 512. We're at 565. I don't know if it's going to go down there. If it does go down to this order block and the 250-day moving average is inside this order block, I would be very interested in that trade for sure. I just don't know if it's going to get there. Again, if it doesn't get to where I want it to, I'm not going to buy it. A secondary level for me to look at this would just be a pullback to the 200-day moving average. 200-day moving average is a strong moving average. I don't like it as much as the 250 because the 250 resides inside the bullish order block. However, if Goldman Sachs does come back down, rejects the 200-day moving average with a good risk to reward ratio, I would consider. So either a good risk to reward risk to reward rejection of the 200-day moving average. That's one potential. The second potential and the more ideal potential is down here with the rejection of the 250-day moving average because it resides inside the bullish order block. Meta. Well, I have been talking about Meta for a few weeks, and I really love this setup, especially on a company like Meta. But you can see all week, I was like, come on, give me that 200, give me that 200, right? 200-day on Meta is a good entry point regardless if it rejects the 200, but it resides inside the green order block. You see the market tried, just couldn't quite get down there. And then it kind of took off without me. So that's okay. Meta might just go all the way up here and I will have missed this really nice confluence. But that's okay. I have plenty of other positions as well. However, next week, if we do go down and we reject this 200, we either close under it, close over it, bounce at it, intraday rejection, that occurs in the order block, I would definitely consider taking that there. Morgan Stanley, MS. Okay, well, nice setup here. Look, we have a close under. Here we rejected the bottom of the order block. That was a legitimate signal by itself, and that would have been a great one. Here's another legitimate signal. Close under, close over the 200. That's inside the bullish order block. That's another good one. So I don't have this one. I missed this one because I had other positions. However, again, if for some reason we do pull back next week and we do reject the 200-day moving average that's inside this bullish order block, I would consider that. Another option is down here. Here's the 250-day moving average, much lower in the order block. I'd rather take that one because the risk to reward's better and your lower pricing, but I don't know if it's going to give us that. I don't know if it's going to give us the 200. It might just go up from here. I don't know. But so I would look for rejection of the 200 next week in the bullish order block, or even more ideally, a rejection of the 250-day moving average in the order block. Netflix. Okay, so you can see the red box I have up here. What is that? Well, I'm looking for a short because this is a bearish order block. Here's your highest up bar close before market structure change. A rejection of the bottom of the order block would be legitimate. Actually, that did technically happen here on the 19th. I didn't take the trade. But you can see we've rallied, but the bottom of that order block is giving Netflix a problem. So if we have a real solid rejection in the order block, maybe we go inside it and then close a little bit right below it, giving me a better risk to reward ratio. I consider a short there. If I have a bearish V1 or V2 inside the bearish order block, I could get short there like I showed you on IBB. If we reject the high of the order block, that would be the most ideal because the risk to reward ratio is better. So potentially a rejection of the bottom, some kind of bearish V1 or V2 inside the bearish order block, or rejection of the high, I would look to get short Netflix. NVIDIA. Remember NVIDIA? Okay, look, I like this signal a lot. Here's the 300-day moving average. We closed under, we closed over inside the bullish order block, and it's worked so far for sure. We still have the order block below us. We still have the 300-day moving average below us. If NVIDIA pulls back, retest the 300-day moving average, this would be a higher low rejection of the 300. Higher low, anything is better. I teach this in my course. We do higher lows on deep dip buys. We do higher lows on return to value V1s, V2s. But in general, anything higher low is better. So if we come down, was the first rejection. Close under 300, close over 300. Now, if we come back down here, retest that 300-day moving average with a close under, close over, bounce, intraday rejection, that would be a better rejection of the 300-day moving average. And again, we have the bullish order block here. So just simply put, if NVIDIA comes back down and rejects that 300-day moving average, very likely it will also reject the top of the order block, and that would be a very good entry point for me. So that's what I'm waiting for and looking for. It might just take off and I miss it. Again, that's okay. I'm only going to take the trade that makes sense to me, and a rejection of the 300-day moving average with the confluence of the order block makes sense. Let's go to res. What's res? Res is residential real estate. How about that? Well, we are getting close to a really nice area here. Look, here's your bullish order block from 212. Change market structure. Therefore, I know where the order block is. A rejection of a major moving average inside the order block to me is a high quality setup. Look here on the 13th. I didn't take the trade, but did it nail it? Absolutely nailed it. Rejection, bounce at the 200-day moving average while being in the order block, and up it went. I didn't take the trade, but look, there's another potential to get long this. The 200-day moving average dovetails with the high of the order block. So therefore, next week, if we reject the 200-day moving average, by default, we will reject the top of the order block. I would definitely consider taking that trade. I'm going to be watching this one very closely on REZ, R-E-Z. Next one, Verizon. All right. I am happy to say that one of my best friends was in Verizon, and I got him out on this day. Why did I get him out? Well, I saw what was happening with the rest of the market. I saw that we may be in a bottoming process, that we were in low RSIs, we were in bullish order blocks. And he goes, yeah, but this is going up. And I said, it's going up because money is coming out of these other stocks, growth stocks, and it's going into safety stocks. But I said, as soon as the market turns up, the safety stocks, the money will flow out and they will go down. He said, you think so? And I said, I know so. And look what happened. I got him out on this day. He couldn't have been more happy. He called me 2 days later. So anyway, I'm glad that call worked out. So now, what am I looking for? Well, look, this is your highest up bar close before you change market structure to the downside. So what does that mean for me? That means that I am waiting for another rally. Now that we're in a downtrend on Verizon, I'm looking for a rally to short. And so I don't know if it's going to get there, but the low of the order block is 46.06. So if we reject the bottom of the order block, that would be my short. I don't know if it's going to get there though. But if it does, I mean, right, what do I know? I don't know anything. If I knew, I wouldn't have to use technical analysis. I would just, buy this, sell this, right? But it's possible that it could go up here. If the market heads back down next week, very likely this will head back up. And if it does head back up and reject the bottom of that order block, I would very likely take a short on that. But we'll see. Maybe it does, maybe it doesn't. But that's ideally for me to take a trade. That's what I'm looking for. A move back up, rejection of the bottom of the order block to get short. Last but not least on the dailies is Walmart. Another one of those super setups. Combination of the 200-day moving average along with the green bullish order block. But it's very similar to Meta. I need that to come down, reject the 200-day. So look, as far as the markets go, I've said the word order block about 9,800 times today, and the 200-day moving average about 1,100 times. But those are the combinations that we're looking for. Does it mean we're at a bottom right now because we've rejected those levels? Absolutely not. It doesn't. But it gives me some hope that maybe at least a tradable bottom is in. But you have to keep your mind open to the fact that it may not be. And so that's why I'm looking at these levels further below. But on Walmart, if we rejected the 200-day moving average while we're inside that bullish order block, doesn't mean it has to be right, but it's a high probability trade with a very good risk to reward ratio, and that's all we can ask. Okay, so those are the potential daily trades for next week. Let's look at the weeklies quickly. Here's Budweiser. You see a red block, that's a bearish order block. Highest up bar close before we change market structure to the downside. I am looking for a rejection of either the bottom of the order block at 65.18, some kind of reversal inside the order block, or a rejection of the high of the order block, which is 67.40. Don't know if it will get there, but if it does, I'll be looking for a short. Salesforce, CRM. Same, everybody. Bullish green order block with the major moving average, the 200 and the 250 inside of it. I don't know if it's going to get there, but if it rejects the high of the order block or it comes lower and rejects these major moving averages, I would consider getting long on a weekly time frame on CRM. Home Depot, HD, very similar. Again, you have the bullish order block, you have the 200-week moving average inside of it. Two options next week. If we reject the high of the order block, that would be a potential trade. Ideally, coming down into the order block and rejecting the 200 would be very good potential way to get long here for me at the 200 with a good risk to reward ratio. MasterCard, MA. Well, this one is held up better than a lot, and we do have an order block here, back here on the 10th. Lowest bar close before we change market structure to the upside. Technically, a week ago, we rejected the high. I didn't take the trade. It's up this week, and that would have been a good trade. But what I am looking for specifically on MasterCard, see the big up bar here on the 17th, big up bar? Halfway of this, that's why I drew this green line. When you have a big up bar and come back to halfway of a big up bar, you generally tend to find some support. So this is the only way I want to get long MasterCard, is if we come back down, reject halfway of this big up bar. So we touch 513 or go below 13, and then we close back above it. The rejection of that halfway of the big up bar inside the order block, I would consider getting long there. What would my stop be? Probably just close below halfway of the bar, or a close below the bottom of the order block, one of the two. Microsoft, well, Microsoft's have had a tough time of it, obviously, and I know the perfect place to buy Microsoft. If it gets there, I don't know if it will. It's the high of this order block back here from the 5th. Here's the high. What is that? 372.36. So I don't know. It may have turned up and go up from here. I don't know. But if we do come back down, test the high of that order block, reject the high of that order block at 272.36, I'd consider getting long there. Oil, USO, here we go again. We have a bullish order block on the weekly. We have the 200-week moving average. I've talked about this for weeks. It's just never gotten there. But for whatever reason, if oil does come down and reject that 200-week moving average, I would potentially get long oil. And I really wish it would, because I like not to only have equities, I like to have commodities as well. But it's never quite gotten there, so I didn't take the trade. VIX. Okay, so this is really important, everybody, because if you've been watching this channel for weeks and months, I've been talking about VIX at this level. And I took this trade, not on the weekly, but on the daily. I took this trade down here when we got into the bullish order block. And I specifically mentioned many times on this channel, if the VIX gets into this bullish order block, that's probably going to signify the high of the market. And boy, did it. And I bought VIX here and had a great trade on VIX simply because of the bullish order block. Now look, here's the red. This is a bearish order block. Here's your highest up bar close before market structure change. Look right where we got to on the weekly. It rejected the high of the order block, of the bearish order block. That's good for stocks. And that dovetails into what I'm showing you on, the potential bottoming for equities, because it dovetails and it's supported by the rejection of the VIX in the bearish order block. So what does this all mean? This all means, what I'm trying to say here is, if the VIX comes back down to this bullish order block, that's very likely the high of the market. And if it does get down there, I would consider buying. It has a long way to go, which means the market has a long way to go to the upside too. But it just simply, if you would have looked at the VIX, every time the VIX got here, lighten up on your stocks would have been a good idea. Every time the VIX got here to the bearish order block, getting long would be a good idea. And you can see, we got into the bearish order block, we rejected it, substantially now, and that's why stocks are moving up. But if we get back down here into the bullish side of this, very likely that will be a top for stocks. Okay, next, XLRE. Okay, this is a little kind of weird one here, but this is a bullish order block on XLRE. XLRE is real estate. I am looking for a rejection of the 250-week moving average inside the order block, or a rejection of the 300-week moving average. Not just a rejection of the high. On this one, I want a major moving average like the 250 or the 300. So I don't know if it gets there, but next week, if we bounce at the 250 inside the bullish order block, I consider getting long. If we bounce at the 300 inside the order block, I would consider getting long. Last but not least, everybody, it's the longest podcast of my life. XLU. It's a bearish order block. Here's your highest up bar close. Market change, structure change to the downside. I've been talking about this for weeks. I want a rejection of the bottom of this order block, ideally right here. Right here, rejection at 81.30. Why there? Well, because you've heard me talk about halfway of big up bars. Well, this is halfway of a big down bar. See the big down bar we have over here? If we get to halfway of that and reject, there's going to be inherent resistance there, and it would also reject the order block. So that's what I'm looking for on XLU potential short. So, woo, that was a lot. But I hope you liked it. I hope you learned something from it. If you did, again, appreciate a thumbs up. If I can help you find a trading, if I can help you and teach you my trading process, like I said, I do have a 15-hour one-on-one course. I would love to have you as a student. I'll teach you everything I know. When you're done, you're going to be a much better trader. You're going to know all these strategies, and the best way to learn anything is one-on-one. So please send me an email. My email is in the link in the description. We could get the conversation started. Just want to say hello to Steven and Pete, two of my current students that we're teaching right now, and they're doing really great. So great job, guys. But I like to leave off with, please try to go out and do something nice for somebody today. If we all did one nice thing every day, it would make the world a much better place. If you could try to also go out, maybe do one nice thing for an animal each day, they would appreciate it. I was raised with many animals as a child, and I know they appreciate acts of kindness just like we do. So why not try it? What could it hurt? It just would make the world a better place. If you have any comments or questions about anything I discussed today, put them in the comment section. I'll do my best to get back to you. I hope you have a really good weekend, and take a rest, maybe do a little exercise, study your charts for sure, and God willing, I will see you next week. So thank you so much if you've stayed all the way till the end, and hopefully I'll see you next week. Thanks, everyone. Take care of yourself. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit, No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.